The quest for global capital, overseas listings as a growth engine. For technology companies, listing on overseas stock exchanges offers significant advantages. It unlocks access to deeper, more diverse pools of capital, far exceeding what might be available domestically. This financial influx is crucial for funding ambitious research and development projects. It also fuels rapid expansion into new international markets. Furthermore, an overseas listing enhances a company's global visibility and brand recognition. This can be instrumental in attracting top-tier international talent. It also helps in forging strategic partnerships with other global players, fostering a cycle of growth and innovation that is vital in the fast-paced tech sector. However, the path to an overseas listing has not always been smooth for Chinese technology firms. In recent years, these companies have encountered increasing regulatory scrutiny from various international bodies. Geopolitical tensions, particularly between China and the United States, have added another layer of complexity and uncertainty. These challenges have sometimes delayed or even derailed listing plans. They have created an environment where careful navigation and robust compliance mechanisms are more important than ever. The ability to successfully list abroad often depends on a company's resilience and its capacity to adapt to evolving global standards and political climates. Recognizing these hurdles, China is now signaling a renewed commitment to supporting its technology champions. The new initiatives aim to facilitate their journey to international capital markets. This represents a strategic understanding that global integration, despite its complexities, remains a key driver for technological advancement and economic strength. By providing clearer pathways and more predictable regulatory frameworks, China hopes to empower its tech firms to compete more effectively on the world stage. This support is designed to help them overcome some of the recent headwinds and continue their growth trajectories. This renewed focus is set against the backdrop of intense global competition in the technology sector. Nations worldwide are vying for technological supremacy, understanding that innovation is a cornerstone of future economic prosperity and national influence. Capital markets play an indispensable role in this race, acting as the financial engine that powers groundbreaking research and the scaling of new technologies. China's efforts to ease overseas listings for its tech firms are, therefore, a strategic move to ensure its companies have the resources they need to innovate and lead in this highly competitive global landscape. On Thursday, May 22, 2025, a significant announcement emerged from China's top securities regulator. Yan Bojian, the chief risk officer at the China Securities Regulatory Commission, outlined new plans at a news briefing. The core objective is to establish a regulatory environment that is markedly more efficient. It also aims to be more transparent and predictable for technology companies seeking to list their shares on overseas exchanges. This initiative signals a proactive approach by the CSRC to foster growth and international participation for its burgeoning tech sector. The goal is to simplify the process for well-prepared companies. A key component of these new regulations involves enhancing the security of funds raised by these listed companies. The CSRC is determined to ensure that capital obtained through public offerings is utilized for the company's primary business operations. Strict measures will be implemented to prevent these funds from being diverted to unrelated ventures or speculative activities. This focus on proper fund utilization is crucial for building and maintaining investor confidence. It addresses potential concerns about corporate governance and financial discipline, which are paramount for sustainable growth and market stability in the long run for any publicly traded entity. Furthermore, the regulator intends to significantly increase its support for high-quality technology firms, even those that are currently unprofitable, to go public. This is a noteworthy shift, acknowledging that many innovative tech companies, particularly in their early stages, require substantial investment before achieving profitability. By enabling such firms to access public markets, the CSRC aims to fuel cutting-edge research and development. This support can help nurture future industry leaders and accelerate technological breakthroughs. It demonstrates a long-term vision for fostering innovation, even if it means embracing higher initial risk profiles for these ventures. These comprehensive regulatory efforts are designed to streamline the entire overseas listing process for Chinese tech enterprises. By creating clearer rules and expectations, the CSRC hopes to reduce ambiguity and potential delays. This in turn is expected to bolster the confidence of both the technology companies planning to list and the international investors considering participation in these offerings. A more predictable environment encourages greater engagement from all parties. It ultimately contributes to a more vibrant and robust global capital market for technology stocks, benefiting the innovative firms and the investors who back them. These new measures supporting overseas listings are intricately linked to China's broader strategic objective achieving greater technology self-sufficiency. This national ambition has gained considerable urgency amidst heightened geopolitical tensions, particularly with the United States. Increased American restrictions on Chinese technological advancements have underscored the need for China to cultivate its own robust innovation capabilities and reduce reliance on foreign technology. Facilitating access to global capital, even through overseas listings, can provide Chinese firms with resources to invest in domestic research and development, thereby strengthening their core technological foundations and resilience. In parallel with supporting overseas ambitions, the CSRC is also committed to deepening reforms within China's domestic capital markets. A significant focus is on Shanghai's tech-focused STAR market. The STAR market was established to support innovative companies in strategic emerging industries, offering more flexible listing criteria compared to traditional boards. The planned reforms aim to further enhance its attractiveness and efficiency. This will make it an even more potent platform for nurturing homegrown tech champions and providing them with the financial backing needed to scale and compete globally, contributing directly to the nation's self-sufficiency goals. Similar efforts are underway for Shenzhen's Chinex board, another crucial platform for innovative and growth-oriented enterprises in China. The Chinex board plays a vital role in funding small and medium-sized tech companies with high growth potential. The CSRC's reforms are intended to optimize its functions, making it easier for promising domestic tech firms to secure funding and develop their technologies within China. By strengthening these domestic listing venues, China aims to create a multi-layered capital market system that can support tech companies at various stages of their development, from startups to established industry leaders. Adding another dimension to its strategy, the CSRC will actively encourage high-quality red chip firms to list their shares domestically. Red chip firms are mainland Chinese-owned companies incorporated outside mainland China and listed in Hong Kong. Enticing these established, often tech-focused companies to also list on mainland exchanges, such as the STAR market or Chinext, would bring significant benefits. It would deepen the domestic capital pool, provide local investors with more high-quality investment options, and further integrate these successful enterprises into the national economic and technological development agenda, bolstering the overall strength of China's markets. China's bold new measures to facilitate overseas listings for its technology firms are poised to send significant ripples across global technology markets. A more streamlined and supportive regulatory environment in China could lead to an increase in the number and scale of initial public offerings by Chinese tech companies on international exchanges. This potential influx of new listings would offer investors a wider array of choices and could inject fresh dynamism into global tech trading. It also signals China's continued engagement with global financial systems, even as it emphasizes domestic technological development and resilience. For international investors, these developments present both new opportunities and familiar considerations. The prospect of investing in the next wave of innovative Chinese tech companies will undoubtedly be attractive. However, investors will also need to remain cognizant of the evolving regulatory landscapes in both China and the host countries of the exchanges. Geopolitical factors will continue to play a role in shaping market sentiment and risk assessment. Therefore, thorough due diligence and a nuanced understanding of the cross-border dynamics will be crucial for making informed investment decisions in this evolving environment. The impact on technology companies, both within China and internationally, will be multifaceted. Chinese tech firms will benefit from improved access to capital and potentially smoother pathways to global markets, enhancing their competitive capabilities. For international tech companies, this could mean intensified competition, particularly in emerging technology sectors where Chinese firms are making rapid advancements. Conversely, it might also open doors for new forms of cross-border collaboration, strategic alliances, or even co-investment opportunities as the global tech ecosystem becomes more interconnected and dynamic. Ultimately, these regulatory reforms underscore China's long-term vision of establishing itself as a preeminent global technology leader. By strategically leveraging both domestic and international capital markets, China aims to fuel its innovation engine and support the growth of its tech enterprises. These financial regulations are not merely administrative adjustments, they are integral components of a comprehensive national strategy. This strategy seeks to enhance technological self-sufficiency, foster economic growth, and reshape the global balance of power in the critical domain of technology for decades to come.